Ladies and gentlemen, welcome to Academia Sinica. Today we are glad that we have Professor Waller to give us a talk on monetary policy after the financial tsunami. And the moderator of this forum is Professor Xu. He's a former central banker. And we have two discussants, Professor Wu, Zhongshu Wu, he's the president of Zhonghua Economic Research Institute. And we have another discussant, Christina Liu. He's the former Minister of Finance of Taiwan. So let's get started. Professor Xu, please.
Professor Jian, Professor Waller, Professor Wu, my dear friends, good afternoon. It's really my great honor to play the role as the moderator of this forum. We appreciate very much the hosting institute and the National Taiwan University for organizing this very valuable and important forum. As we all know, since 2007, the world economy has suffered from major turmoils. The central banks of most countries have adopted various monetary policies to speed up the recovery of their economies. During this period, we observed some major change on central banking. The role of the central bank, the philosophy of monetary policy, and the implementing method of monetary policy were quite different from the past. And we also know, in fact, the US Fed is the pioneer in leading these changes in central banking. So today, we are very fortunate to have Professor Waller to deliver a keynote speech on monetary policy in the 21st century. Since Professor Waller graduated from Washington State University with an economics PhD degree in 1985. He has taught at Indiana University, University of Kiev in Ukraine, University of Kentucky, and the University of Notre Dame. He joined the Federal Reserve Bank of St. Louis in June 2009. As we all know, the Federal Reserve Bank of St. Louis is a very important and influential think tank in monetary economics. Now, Professor Waller is a senior vice president and in charge of the research department of the bank. He has long time engaged in the research on monetary economics and personally observed the operation and the changes of the U.S. Monetary policy. He's one of the most qualified experts to talk about today's topic. May I now invite Professor Waller to make the what we expect, a very important speech. Let's welcome. Thank you.
Well, thank you for inviting me to talk. Professor Wang Ping is very well known here in Taiwan, and he's a colleague of mine back in St. Louis. And I was going to a conference in Beijing the last few days, and Ping asked me if I would come to Taiwan and give a talk. And I said, yes. He said, be very provocative. So say some things to create challenging ideas and controversy. So that's what I'm going to try to do in this talk, and that's why we decided to call it 21st Century Central Banking. So what I will say is, since the financial crisis, monetary policy is in a new world. we sit around in St. Louis and talk with my president, James Bullard, who's on the Federal Open Market Committee and makes decisions on U.S. monetary policy. And many of the things that we used to use to guide our thinking about monetary policy don't seem to be working. And so that's what I'm going to do today. I'm going to make a very bold statement. Oh, and first of all, I should say, any opinions expressed are my own. They do not reflect those of the Federal Open Market Committee, the Federal Reserve Bank of St. Louis, anybody remotely connected to U.S. monetary policy. They're strictly my own thoughts. So I'm speaking more as an academic today. So I'm going to cover three, what I'm going to call old monetary policy ideas, and old because they don't seem to work, and argue that it's time to potentially abandon them, at least for some period of time. And the first one is something we all know and love from economics, which is the Phillips curve, so we should stop using this. Second, what we see around the world is central banks adopting zero interest rates in the US, Japan, Europe, in an attempt to try to cause inflation. And then lastly, with all the quantitative easing that's been done around the world, there's this fear that all of this monetary expansion is going to cause inflation. So these are three basic ideas I want to challenge and make us rethink whether we should be using them or not. So the Phillips curve is a very traditional view of relationships in macroeconomics that assumes there's a trade-off between inflation and the unemployment rate. And so the idea is that stronger real GDP growth leads to falling unemployment rates via Okun's law. I'll talk a little bit about Okun's law. It's unfair to my discussants. I just put this in the talk about 20 minutes ago. So the whole idea is that eventually this falling unemployment rate, growing economy will cause inflation to rise. Okay, this is an old Keynesian idea based on sticky prices and sticky wages. It's also in the workhorse New Keynesian model, which is used around the world in central banks to think about monetary policy. And one of the key three equations in a New Keynesian model is a Phillips curve. That's one of the three things that drives all the behavior of the model for guiding monetary policy. So, one of the things we know is that central banks can use monetary policy to try to stimulate aggregate demand. And with this, what we're trying to do is push up prices, increase output, and lower unemployment. Now, most monetary policymakers in the early 1960s and 1970s believed that the Phillips curve offered them a menu of policy choices. Much like going to a restaurant, you could say, I'll pick this, or I'll pick that. And so this was a very, like I said, it's a very old view of the world. So just a stylized discussion, the Phillips curve would be given by the red line. And in the 1960s, the view was, well, if we want really low unemployment, say 2%, we have to be willing to accept 6% inflation. Alternatively, if we want really low inflation, we have to accept very high unemployment. Okay? So this was the prevailing view in the 1960s, okay, and that there was this trade-off that central banks have to make. Now this idea, this stylized Phillips curve I just showed you, using this as something that was a truth for macroeconomics was cemented by the experience in the US in the 1960s, and it appeared to be almost like a law of economics. But what is the evidence to support it since the 1960s? So what I've got plotted here is the unemployment rate on the horizontal axis lagged a few months, and what we use in the US for our target inflation rate, which is the PCE inflation rate. And if you look at the blue dots, which go from these are quarterly, from I'm pretty sure it's quarterly, maybe not, 1950 to 1969, you can see this very clear relationship between unemployment and inflation, and the dots are very tightly centered around that line. I mean, this is a very good relationship. And you can see roughly 8%. You know, once you got up to 8% unemployment, inflation will be down close to 1%. And if unemployment got to 4%, inflation was up to 4%. So not only was there this very tight relationship, it was also what I'm going to call fairly steep. Here's what we all came to realize when I was in graduate school, in undergraduate in the 1970s. Something went very wrong with the Phillips curve in the 1970s. Okay? The curve shifted up, it flattened out, and this dispersion got very large. Now, there were lots of theories and stories that talked about why this might be the case. Then, in 1983 to 2007, we entered the period of the Great Moderation, and if anything, the Phillips curve went the wrong way. Okay? Actually, if you wanted low unemployment, you needed low inflation. Just the opposite of what people thought was the case in the 1960s. Okay? Since the financial crisis, it's shifted down again, and now it's almost completely horizontal. Okay? There seems to be absolutely no relationship between the inflation rate and the unemployment rate. The unemployment rate has moved from 4 to 10% and back, and inflation has hardly moved around 2% or slightly less than 2%. So any model that you're using to guide central bank policy that has that picture as an equation in your model is going to work very poorly in the world of the black and the green lines. Yet we persist on having it in our models. It's just kind of a strong belief among central bankers, there has got to be a Phillips curve trade-off. So just another piece of data, this is just the correlation between inflation and the unemployment rate since so it's a temporal correlation between 12-quarter correlations over a period of time. And once again, you can see that the correlation between inflation and unemployment was very strongly negative through the 1960s, even through the 1970s. But then, since then, it's sometimes strongly positive, strongly negative, strongly positive. There doesn't seem to be any stability in this relationship. So again, I'm going to argue that it's not a good idea to base monetary policy on a relationship that is that unstable. It's not going to guide you very well in thinking about what to do. So I'm going to argue the Phillips curve is a failed idea. It's a failed relationship to think about for guiding policy. And the other thing that has failed dramatically in the last, say, 10 years has been what's called Oken's Law, which is just that output growth is going to have a negative effect on unemployment of this relationship. We basically at the Federal Reserve, at least in my bank, we've thrown this equation away because it doesn't work. It just doesn't work at all. Unemployment has fallen dramatically, and output growth has been very modest at best for the last 7 years. So again, it's not going to tell you anything about output growth and unemployment. So it's time for central banks to sort of abandon both of these concepts as a guide to policy. Now, this is something that every central bank around the world is trying to do, and that is to keep the interest rate, the policy rate, near zero to try to stimulate the economy and bring inflation up. All right, and the reason I'm going to argue where the problem comes in is through what's called the Fisher equation. In the United States, if you like to read blogs, economic blogs, this is a thing that's been raging for several years. Right? So this is just what we call the Fisher equation, and it says the gross nominal interest rate is equal to the product of the real rate of interest and the expected rate of inflation, the gross expected rate of inflation. Now, in this equation, this is a sort of a short-term policy rate. This is one equation and three variables, I, R, and expected inflation. Now, the I is under the control of the monetary authority. That's what the ECB, the Bank of Japan, the Federal Reserve, we control this short-run interest rate. Now, in a Keynesian view or in a new Keynesian model, the argument is inflation expectations are sticky. They're very sluggish. They don't move. The reason is that either there are some sort of backward expectations, which would have been the 1960s view of expectations, or the more modern view in a new Keynesian model is that expected inflation is anchored by the inflation target of the central bank. So the Federal Reserve adopted a 2% inflation target in 2012. European Central Bank has had a less than 2% inflation target, but not negative, since the founding of the ECB in 1999, and the Bank of Japan kind of recently adopted a 2% inflation target as well. Now, in this world where this is sticky, if you lower the nominal interest rate, the real interest rate's going to fall. Now, in a classic Keynesian view of policy, when you lower the real interest rate, you'll expand borrowing by households and firms, and this will increase aggregate spending. And this, by all aggregate demand, aggregate supply, Keynesian views, is going to cause inflation to eventually rise. Okay? So that's what every central bank around the world is trying to do, is drive inflation low, try to stimulate demand and push inflation back towards target. Now, one of the things that's interesting here is that basically it's assuming that lenders are shifting funds from safe assets to risky assets. So this is what people call reaching for yield. You're trying to drive down the real interest rate on short-term assets or safe assets and drive lenders into risky lending, which is households or firms for investment. So you this is one of the puzzles, is necessarily why would lenders want to take on more risk for low return? Okay? If the return is low, I might just prefer to move into even safer assets. Rather than lend, just move into safe assets. Furthermore, if you're going to induce firms, banks to lend, move from safe assets to risky assets, which would be private loans, they have to raise capital to offset this risk. By all the Basel capital restrictions, if you're going to shift your portfolio from safe to risky lending, you've got to raise capital. And firms view that, banks view that as a tax on them. So you're trying to get banks to basically shift their portfolio towards more risky lending, and with no idea that, or thought given to the fact that they have to raise capital to offset this risk. This is a classic kind of picture that drives all this thinking. There's some sort of loan demand on the part of households or firm. It's as the real interest rate falls, people are willing to borrow more, take on riskier projects, lower return projects. And so implicitly the loan supply curve here just automatically provides whatever anybody wants at that new interest rate that the central bank is choosing. So this is just a simple picture of what a classic Keynesian model would give you. Now, there's another camp out there, and if you, like I said, if you read the blogosphere, they will take the opposite view, which is that inflation expectations are not sticky at all. They're endogenous. They're going to respond to things. That when you lower I, if temporarily, if inflation expectations are constant, and you lower the real interest rate, then as a lender, I'm not going to get the real return I need on lending. Or I needed this higher rate, you're forcing me to try to take a lower rate. And what's going to happen is they're going to respond by contracting lending. So let me just, and decrease aggregate spending. So if you think about it this way, if central banks try to force the real interest rate down and loan supply is, say, upward sloping, banks are going to respond by saying, I'm just not going to lend as much. The return to me from making this loan is very low. What is the point of making these loans? Sure, at the low real interest rate, people want to borrow a lot, but it doesn't mean lenders want to make the loans. So here's another example to think about it this way. Here's how we increase employment. Cut everybody's wages. Beautiful. Firms love that. But the workers say, why should I work then? I'm not going to work as much if you cut my wage. There's lots of things where we forget that there's an equilibrium here, and that if you try to force the interest rate away from that, you're going to end up on the short side of the market, not the long side of the market. So from a neo-Fisherite view of the world, all that's going to happen is you're going to reduce lending when you drive down the returns to lenders. They're just not going to lend. Okay? So if they contract lending in response to getting lower real yields, you're going to put downward pressure on demand and downward pressure on inflation. In other words, if you're going to lower my real yield, I'm not going to make risky private loans. I'll shift to safe assets. And in fact, that's one of the things we're seeing in the world. Banks are shifting a lot of their resources into very safe assets, not risky lending. So as there's this downward pressure on lending, that's going to put a downward pressure on aggregate demand. Inflation will decline, expected inflation declines until R is restored back to its previous level. So it's just these blue lines. Inflation is going to fall such that the real return goes back up, and we end up back at L0 and R0. So you have to distinguish between this kind of idea that the supply side of the market will do whatever borrowers want. That doesn't happen. All right, so we have a tension. We have two theories. One is a Keynesian theory, says if you lower the nominal interest rate, you lower the real interest rate, you stimulate the economy. You have a neo-Fisherite view, which is if you lower the nominal interest rate, you're going to put downward pressure on expected inflation. Now, the new Keynesian view of this is probably okay, and this is why it's been used for several decades. It's okay if you think of what the central bank's trying to do is deal with very short-run cyclical movements in, say, output or unemployment. The neo-Fisherite view is something that if you try to do something for a long time, this is more likely going to be the outcome. Okay, it's more of a moderate to longer-run view if you keep the nominal interest rate suppressed, trying to push down real interest rates below what their normal level would be. So we have a horse race, as we say. So what do we do when we have two competing theories? Let's go to the data. Okay? So what I've plotted here is the short-term interest rate for the euro area 18, for Japan, and for the United States, and their measure of inflation that they tend to look at. Now, what I want to stress is that, in 2002 or so, we could see that, inflation was up here, but as the policy rate began to fall, inflation didn't go up, inflation kept falling. It's true for Japan, true for Europe, true for the US. And the green triangles are a combination of the policy rate and where inflation actually is. If you notice, almost all of the green triangles are to the left of the targets for all of these central banks. So they've driven the policy rate down for over 7 years. I mean, this isn't 4 quarters and you get some. This is 7 years. You've had the interest rate at 0 for 7 years, and you get, if anything, you can't get inflation close to your target. That's what the green triangles are telling you. Now, Japan with Abenomics had a brief burst, but the last observation is they're moving back and falling again. So this idea that if we just keep interest rates at 0 long enough, we're going to get a lot of inflation, 7 years. How much longer do you want to wait? Japan's been doing it for 15 years. Okay? So the policy rate has been at 0 in the US since December of 2008. We can't get inflation to get up to 2%. It's been nearly 0 for Japan for 15 years. And for Europe, it's been near 0 since 2008. So if I equal to 0 for over 7 years does not generate any inflation, by the standard new Keynesian or Keynesian view of the world, when is it going to? Okay? That's what I mean. The world has changed on us as central bankers. This idea that we'll just keep the interest rate at zero and that's going to cause inflation when demand stimulates and takes off, it's not happening. Okay. So, given the evidence for the three large economies in the world, keeping the nominal interest rate at zero, at the zero lower bound, does not appear to be a winning strategy if the goal is to create inflation. Okay? This mechanism isn't working. So to try to keep beating on this mechanism to cause inflation isn't necessarily the right idea. So there have been calls by some of the FOMC members, in particular Narayana Kocherlakota, that the Fed should keep the interest rate at zero until inflation is 2% or higher. The Fisher view of the world is you will be at zero forever because it will never go back up. It will just continue to go down, if anything. Okay? So Fisher appears to be winning. Time to abandon Keynesian strategy number 2. Now I have to be fair and pick on the monetarist as well. I come from the most famous monetarist central bank in the world. So one of the things that we've seen since 2008, once the interest rate went to zero, central banks tried to do other things to stimulate inflation, stimulate the economy. And we've seen what's called quantitative easing. In the US, Chairman Bernanke despised this phrase. He liked to call it large-scale asset purchases, LSAP or LSAPs. The European Central Bank calls it something else. They don't like to call it quantitative easing, but the word stuck, so I'm just going to stay with it. So quantitative easing policies by the Federal Reserve, the ECB, and the Bank of Japan have caused their balance sheets to explode. This has caused dramatic increases in the monetary base and excess reserves. So this is the balance sheets for all three central banks as a percentage of nominal GDP. So what you can see is the Federal Reserve is the black, the Bank of Japan is the gray, and the European Central Bank is the dashed blue line. All these banks, for a number of years, kept their balance sheet at a relatively stable, Japan a little more fluctuation, but a relatively stable ratio or percentage of nominal GDP. The US, it was about 7.5%. European Central Bank was roughly 10%. And you can see QE1. We see QE for the sovereign debt crisis for Europe. And we see the most recent QE for the Bank of Japan. The US now has a balance sheet that's over 20% of GDP. We've more than tripled it as a fraction of the size of the US economy. Europe drove it up to 30%, it drifted back down. They're now trying to drive it back closer to 30% from around 10. And the Bank of Japan is at 60% of GDP from around 25 or 20, and they're trying to get to something like 75 to 80 or 90%. The Swiss National Bank was at 100%. This is massive, massive expansion of the monetary base around the world. Now, many have argued, particularly old monetarists, Alan Meltzer, many of his colleagues at the Shadow Open Market Committee, that a potential disaster is waiting in the wings. Now, they've been saying this since 2009. Let me keep that in mind. And this is the argument. This explosion of the monetary base will eventually lead to lots of loan creation as the economy recovers. These reserves are going to flow out of the banking system and cause a huge amount of lending, explosion in aggregate demand, and an explosion in inflation. Okay? They've been saying this since 2009. 6 years. We've seen all of this, and what is inflation? I showed you. We can't even get inflation up to our target. Okay? So where does this belief come from? And I'm going to be kind of blunt. Old monetarists, which Alan Meltzer's one, as smart as he is, they always think of the quantity equation. Something we teach in principles. I'm guilty as well. Okay. And the old quantity equation is MV equals PY. Okay. And if you're any kind of a monetarist or a student of Friedman, you know that velocity and y are invariant to changes in m. So if you increase m, prices have to go up in the same proportion. I mean, this is just what we teach our students. I bet we've all written exam questions, and the students in the back have probably answered an exam question like this at some point. But this thinking about monetary policy in this old monetarist fashion is based on two critical assumptions. First of all, it's a very static exercise. It's a one-time permanent increase in the money supply that is never removed. And the increase in M is a helicopter drop. A famous Milton Friedman phrase, you just might as well load up cash, put it on a helicopter, and drop it over a shopping mall somewhere. Okay? Here's where that thinking goes completely wrong. Modern quantitative easing policy is the following. It is dynamic. It is not a static one-time drop some money on people. And it is by design for almost every central bank I'm aware of, it's designed to be temporary. We're going to do this, and then we're going to undo it. The Federal Reserve has been saying this since 2009. We are not going to permanently leave this in there. We will take this back out. We will shrink our balance sheet back down. Okay? It's a very different example than a helicopter drop where you say, I'm going to put the helicopter drop in, and then in a few years I'm going to take it all back out. It's a very different exercise. You have to think very differently when you do this. Why can we reverse these things? Because they're not helicopter drops. When you do a helicopter drop, you're giving money to people. You have no way to make them give it back to you as a central bank. The government can go get it by taxing people and say, give me the cash, hand it back to the central bank, and we shred it. But that's not what we're doing. We're buying stuff. We're buying debt instruments. Okay? In the US, we buy treasury bills, mortgage-backed securities. These are all debt instruments that with any debt instrument, at some time they mature and they have to be paid back. And when they're paid back, we get our cash back, we shred the money. Okay? Or we can always sell the assets. The Bank of Japan's buying equities. Equities don't mature, but you can always sell them. And that's how you get the cash or the liquidity back out of the economy. So this is the question. If you do this, not this, we're not doing this. We're doing this. Will this cause inflation or have any beneficial effects? I mean, one of the things that central banks think is that this has some beneficial effects on the real economy by doing this. This is in part why the ECB is doing it. Well, this is where you have to go to some thinking about theory. So Neil Wallace wrote a paper in 1981 about open market operations and said when you're printing money and buying government debt, you're swapping one government instrument for another government instrument. It's like switching a red piece of paper for a green piece of paper. What can that do? So any model that have what we call Modigliani-Miller properties to them say no. You know, the composition of the assets on the government's balance sheet or these financial assets can't have any effect. And so that was the Wallace paper in '81, and John Cochrane has some more modern versions of this in 2005. So what this view of the world says is QE will have no effect on inflation or on the real economy. Now what this view says is don't even bother doing it. Okay? But many central banks would say, well, if it's going to do nothing, we should at least try and see. We'll at least find out. And this is particularly true at I equal to 0. A government bond that pays no interest looks exactly like a dollar bill that pays no interest. They're equivalent pieces of paper issued by exactly the same authority with the same default risk and the same maturity. So, now, however, there are some other monetary frameworks out there that actually have some micro-founded frictions that kind of break this Modigliani-Miller property. And Yi-Ting Lee works in this area along with me. And so I have a couple of papers with Alex Berenson and recently with Paula Bohl that look at exactly this idea of QE, where you put it in when there's a friction, and this putting it in actually benefits the economy, and then you take it back out when the friction isn't as severe. Things kind of normalize. And we show in these two papers that you can actually improve welfare even if the interest rate's at the zero lower bound. Steve Williamson, in a paper in the American Economic Review not too long ago, showed a similar thing, that by doing QE, where the government, the Federal Reserve, or the central bank steps in, buys longer-term securities, you relax collateral and borrowing constraints in the economy, and that this actually can have a positive real effect. However, in his model, that QE actually pushes inflation down. It does not push inflation up. So in my papers, it has no effect on inflation, but it has some positive effects on output. In Steve's paper, it has positive effects on output and actually pushes inflation down. Again, it's the opposite of this Phillips curve idea. Okay? All right. So contrary to the Wallace paper or Cochrane, this literature says, for these papers, by doing QE, you can actually have some beneficial effects on the economy, but it's not going to cause inflation like you may think it does. It may actually, as Steve's paper shows, it may push it down. So contrary to the old monetarist, and as many wailing and gnashing of teeth that has gone on in the old monetarist crowd, QE has not caused inflation in the US, Japan, or Europe. Now, I should make a comment here that in the work that I've done with QE, the reason QE has effects is because the central bank is credible in its promise to undo this. Okay, credibility is important to not cause inflation. New Keynesian models have tried to figure out a way to do QE. The way it works in those models is that the Fed, or the central bank, has no credibility. So when they do QE, nobody believes they'll take it back out. This is going to cause inflation. Hasn't worked. So I take it as a fact that people actually have a tremendous amount of credibility in the Federal Reserve that we will undo this at some point. Now, it clearly hasn't caused inflation. So this kind of new Keynesian view or old monetarist view isn't there. Now, the evidence is mixed, however, as to whether it's had any expansionary or positive effects on economic growth in the economy. U.S. growth, in particular, has been very weak in the last 7 years. Instead of a roughly 3%, it's growing at about 2.25%. And this has got everybody concerned. Larry Summers talks about secular stagnation. This is now a catchphrase in policy. And Chair Yellen, in a speech in San Francisco 2 weeks ago today, actually said if we do have this kind of permanently, the Federal Reserve will have to push interest rates, nominal interest rates down, and real interest rates down for a very long period of time. Kind of goes against the idea of kind of long-run monetary neutrality that most of us think is more probably the best description of monetary policy in the long run. This idea that the Federal Reserve could push down real interest rates for decades is a very unusual thought. Now, what do we know? I'm just going to touch on, I had a lot more slides on the actual evidence. Well, what are the effects of QE? Well, a lot of the evidence, and I actually had it in here and I took it out for this reason. Most of the empirical work that's done looking at QE does what they call event studies. You look at some financial data like stock prices or bond yields before an announcement, and then when the announcement comes out, look and see what happens afterwards. These are very short-term, high-frequency studies, and they're all on financial market, not the real economy. Okay. Now, there has been some recent papers. I just saw a paper in Beijing by some people who are looking at the effects of U.S. QE on emerging markets. And they find through standard kind of VAR analysis, there does appear to be some real impact in emerging economies from U.S. QE. But this paper is one of the first that looks at it, and they find that QE2 increased GDP growth by maybe 1/3%. Maybe that's not big, maybe it's significant. And they also find that inflation just doesn't respond to QE. So QE appears to have had no effect on inflation, which is consistent with these more modern models of monetary policy. And they might have had some effect, albeit it potentially may be a very small effect on output. And this is just the plots from this Chen et al. Paper. When they looked at the data for QE2, the red line is the impact on GDP, maybe 1/10 of a percentage point that slowly declined to 0. These are confidence intervals, so it was clearly above 0, but it may have been quite small. It had some marginal effect on inflation, but this is infinitesimally small. I mean, this is so small, we round off that number when we report inflation. We don't go out to the second digit, okay? So their evidence, independent, is that no effect on inflation, some positive, albeit I won't say it's a large effect on GDP growth. So I'll conclude. Old Keynesian and old monetarist policy predictions are just that. They're old. Okay? 21st century monetary policy requires new thinking, and I tried to illustrate a couple of papers that are in that mode. Of course, mine's one of them. But one thing I want to stress is that what we're observing now is we're seeing something that is not normally business cycle frequency. We typically think of business cycle frequency as a recession lasting 2 to 4 quarters, maybe 6. Okay, and then a recovery is another. So you're thinking of business cycle frequencies of 4 years. We're now in year 7. We're actually in year 8 of the last peak to peak kind of expansion. So what I've been kind of thinking and stressing is we have to get into thinking about medium-term cycles, things that last 5 to 8 years. And once you get in that world, the old models, which were very high-frequency business cycle kind of things, they don't work. You have to get away from this. And like I said, to give you an example, the idea that the Federal Reserve or any central bank could force real interest rates down for 8 years kind of violates any concept we think of monetary neutrality. Something else is going on. It may be that real interest rates are low because that's what the markets want. There's a lot of evidence that there is a shortage of safe assets in the world. If you think about before the financial crisis, mortgage-backed securities were abundant in the U.S. and AAA rated. These were as safe as U.S. government debt. They're gone. Greek debt, prior to 2007, was a AAA rated safe asset. I don't think anybody would look at Greek debt right now and think it's a AAA rated safe asset. So there's been this kind of drop off both on the private side and on the public. A lot of sovereign debt is not viewed as that safe anymore. So when the supply of safe assets falls, the price of those assets goes up and the yields go down. So potentially the reason we're seeing very low interest real rates is not because the central banks are doing anything to them. It's just what the market is willing to do. Chairman Bernanke, almost 10 years ago, talked about the glut of savings in the world. A glut of savings looking for safe assets. And in that time period, not only has there been a big demand for safe assets, but the supply has shrunk. So it may not be possible for us to sort of control real rates when that's the world we live in. And that's not going to be a short-run phenomenon. Those are long-run, I've said. This started happening 10 years ago. So the punchline of this is we need to start thinking about models where frictions are definitely longer lived than simple price and wage stickiness. So in new Keynesian models or Keynesian models, what drives everything is some sticky price, sticky wage friction. All the evidence we know and have is that those prices, on average, change once a year. So if you're building a model where that's the friction to explain something that's been lasting for 7 years, it's going to fail. You have to think about some other frictions that don't go away very easily. And by that, I want to think about things like debt constraints, borrowing constraints, collateral constraints. There's no reason to believe that your debt constraint is going to change over 5 years. Okay? They can last a very long time. So once you start thinking about more medium-term cycles, you have to think about frictions that don't go away very easily. Sticky prices and wages aren't it. You can recontract, you can reprice, you can reset things very quickly and very cheap. It doesn't cost that much, particularly in an electronic pricing world, to change the prices of things. I watch gas prices change every single day in the US. Okay? So for those grad students that might be out there, start thinking more of models where these are the constraints in the world that you care about. Liquidity constraints, debt constraints, collateral constraints. Okay? Anything that doesn't go away very quickly. And that's where I think the current frontier of monetary policy research in, and that's the research that's going to guide central banking in the 21st century. And with that, I'll stop.
Thank you, Professor Waller. And in his lecture, he pushed down several so-called old-fashioned monetary policy thinking. And naturally, we have the puzzle, then what should be the new one? But as usually occurs in the classroom, the teacher always said, well, I also don't know the answer, but I can point some directions for you to have further research. That's the conclusion. And as we know, there are several professors teaching monetary economics in Taiwan. Maybe at the last session of floor discussion, we will have some chance to talk about this, the exchange and ideas. But before that, we have 15 minutes at recession, and let's take a rest first. Then after that, we will listen to Professor Wu and Professor Liu. Now, that temporarily stop here. Okay, thank you.